Hey everyone, and welcome back to my YouTube channel. Today we are talking about the reverse budgeting method, or how to budget when your income goes up and down like that throughout a year. The first point is you need to work out what is the absolute minimum amount that you need to live on a month-to-month basis. The minimum is what I'm talking about in terms of groceries, water and electricity, rent, and any serious debit orders that might bounce if you don't make enough money. In US dollar terms, it might be $1,000. In South African Rand terms, it might be 20,000 Rand a month. But you need to work out what is your absolute minimum that you need per month. So let's say it's 20K and that is ZAR. Okay, so that's what you need. That is step one. So over a year, you need 240K. Okay? Yeah, that's right. All right. The next step is to check out in which months do you make them the least amount, and if it's below your minimum. So it might be 10K, right? 10K ZAR, and your max might be 100. So you want to see in which months you make a lot of money and in which months do you actually struggle. So it's going to look like that. Or you might have months that's good, you might have months that's bad, but you want to see in which months you have rainy days and in which days you have, or which months you have summer days. And you can work out that there might be a cycle of good and bad months. For example, in a tax firm, the one that I run, our good months are usually between July and October, and our bad months are usually March right up until June. So we know that those are good and bad months. All right, so now we know our minimum is 20K, and essentially the first step is to build an emergency fund of 6 to 12 months of your expenses. So if your expenses is 20K, you want to build that fund, the emergency, up by times by that by 6, that gives us 120K. So that anytime that there's an emergency, you can survive on your minimum for at least 6 months. If you have an emergency fund for 12 months, it means that you can survive for an entire year. That means your family can still eat, you still have water and electricity, you can still pay rent, you can still pay some debit orders without running out of money. Okay, so that is the emergency fund. The second thing to do is in the months in which you make more money, and let's say you've got an 80K month, right? You only need 20K, but what you live on is 25. So for that month, you decide you're gonna use 25 that you're gonna live on, and you're gonna save the other part. So you're gonna save 55K is going to go straight into your emergency fund. So basically, in your good months, you want to build towards your emergency fund, ideally between 6 to 12 months. And then once it's funded, you know that you're good for a year in your bad months. Now, usually this takes a while to build up, but effectively, you know that winter is coming. You know, like if you do this exercise, working out when are your bad months usually, according to the past, let's say 2 years that you've been in business, and when are your good months? And then you know that you can use your good months to save for the bad months. Does that make sense? Cool.